So it's a great pleasure to welcome you today for this conference 934, Conférence 934.
I think it's important to realize that 5 years after the Paris Agreement, we have CO2 emissions which have continued to rise. And today, despite all the action that has taken place and despite all the mobilization, we are still on the wrong track. And a lot of effort has to be done in this decade, in the next 10 years, if we want to have a fighting chance, I would say, of keeping the economy on a path to low carbon. Just to give you a sense of the urgency and a sense also of what needs to be done, we need to pretty much halve CO2 emissions, global CO2 emissions by 2030 if we want to be on a path to meet the Paris Agreement targets, which are, as everybody knows, to keep the economy on a warming basis, not well below 2 degrees. And
I wrote a book 2 years ago called Can Finance Save the World, which was an optimistic book, which took stock of the commitment made in 2015 around sustainable development goals and climate in particular, and built on the idea that finance will follow the trend and adapt itself to the needs of a more resilient, sustainable, and inclusive growth model. And I really believed in that. We have had this deviation where finance has taken too big a space, sorry, in the room. And it's also built on the changes that have happened, particularly in the US 50 years ago, which have really unnerved all our system, the accounting principles, the compensation policies, the governance, etc., etc. All the rules that really control the way market economy is operating today.
I just want to make a point on the role of the elected government. They are the ones who can take the tough decisions required by transition. Because above all of their redistributional effects. And in democracies and with the US, we share, and I can say it today even more than ever, we share common values, and we want to promote a certain vision of society where decisions are taken on behalf of the citizens. So carbon pricing, regulation, taxes, this is the job of the governments. And regulators and supervisors are not in charge.
And we've seen in the last few months, I think, a really significant ramp up in climate ambitions by banks. So at my bank at HSBC, we announced some new commitments to support the transition to a net zero economy. We are going to be ourselves becoming a net zero bank and aligning our financed emissions portfolio to the Paris Agreement by 2050 and committing substantial sums of money to help our clients transition also to a low carbon economy. We did a survey a few months ago that shows that 85% of companies believe that climate change will impact their business model, and 55% say that they are being impacted now by climate change.
Banks, in a very stylistic fashion, can influence the private sector through stewardship, through the dialogue that we have with our clients. We can influence the ecosystem by developing what we call sustainable finance, which is on the financing side. And we can influence the ecosystem also through pricing.
From a macro point of view, there is a huge need to accompany the transition, and it's in emerging markets because emerging markets together and developing countries represent about 2/3 of global emissions of CO2. The need, for instance, to build infrastructure in emerging markets because of urbanization, because of demographic and economic growth is extremely important. So making sure that this infrastructure is is compatible with the Paris Agreement, is low carbon, is sustainable, is climate resilient, is really important. And the needs are enormous. They've been estimated at approximately a financing gap of about $3 trillion a year, but very little money is flowing into that.
The truth is that climate is a disruption. And if you look at it from the financial angle or from the legal angle, for example, do we need to change our vision of property rights? Do we need to define natural capital? Or do we consider that as human health is impacted, we should think differently the way we look at the silos in which we work between the people dealing with environment to the one dealing with health, etc. And we are just at the beginning, and to a certain extent, I perfectly understand and I feel it myself. You have a feeling of being overwhelmed by the magnitude of the change you have to organize and to accept. And we are not far enough.
The problem right now is that many view the transition as a cost, when there is a way to view it as a pro-growth exercise. The problem is we currently don't have the right baseline. We really need to change or to evolve our metrics to value the future in the present. And if you do that, if you reintroduce risk premia in asset valuation, Sylvie was mentioning natural capital, for example, or carbon price. If you reintroduce those risk premia that are simply ignored today, you view the future in the present very differently, but you also view a number of actions as actually very, very supportive of growth.
The president himself, maybe he was wrong, actually, but that's the word he used, say we are at war in March. And so we all know that after a war, we need a peace. And when you discuss peace, you have two avenues. One is the Treaty of Versailles, and the second one is Bretton Woods. Treaty of Versailles is to find who is guilty and punish them and see how you can reorganize the world to your own benefit. And I don't think this is what we want, but it's a typically America first, France first, Germany first, etc. type of mentality. I hope we'll avoid that. Or you go the Bretton Woods avenue, where basically you might argue that Bretton Woods was led by the US, which is true, but still, it really reopened the door to globalization after the Second World War. And so the idea to discuss the system in itself, I think, is extremely important.